All right. Good morning, everybody. So it really seems like the biggest thing that we have on the docket today is Fed speakers, whether it's in the US or Europe. We got Bank of England, Governor Bailey, and that was the biggest. Housing, it does stack up, but really that's just the worst one is Fed speakers. We do have the 20-year bonds, so additional auctions. And a typical Wednesday, we do have the crude report today. This ties in with the strategic petroleum purchases that the White House had announced. So something to think about there. Could see a little more out of this week's announcement, price wise. If you don't trade CL, you could look at trading USO. The market sold off yesterday afternoon when the president announced that he would fly home early to re-engage in this debt ceiling debate. Market didn't like that at all. And now it seems a little bit of stabilizing for the same reason that debt ceiling. All right, so I thought this was worth mentioning today. You can see in the later part of the day yesterday, right around 3:05, 3:06 in the afternoon, this massive spike. What we're looking at here is market net flow. So it's combining all the premiums, call premium, put premium, and then SPY and white. So when we have more positive call volume than negative call volume, this green line goes up. When we have more positive put volume than we do negative put volume, then the red line would go up. That was a substantial, drastic change in call volume yesterday. And I'm on a 2-day right now just to give it some scale. We're looking at 5:15 and 5:16. But if I just take it to yesterday, so 1 day right there. We went from a 20-ish, just putting a little ballpark on it, to an 80 in nearly the blink of an eye. And this isn't just SPY premiums, it's combined net premiums across all the stocks in the market, anything that has options, basically. So just kind of wanted to point out, some of these tools may be a little complicated, or maybe, a lot of times you can't quite get a grip on what it's telling you, but it's really hard to mistake this, right? And you guys probably can't see it if I haven't shared my screen. That would help a lot, wouldn't it? Been messing with these Zoom apps and I got distracted with that. Didn't share the screen. You should be able to see it now. So this is what we're looking at though. It's trading ticks market net flow. Nope, it wasn't you. You didn't break it. On the Zoom that on my side, I have this app that was showing my screen, so it looked like it was streaming through. So this is that net flow, right? It's only on yesterday's now, and it really stands out where we went from a 20 to an 80. But if I back it up to a 2-day, I mean, it's still pretty extreme. Give it a 5-day view. So you look back here on the 11th when we started to get some really extreme push from the call side of things. And you can see how the market was selling off that day. And the big calls came in where these dots are at. And the next day, we had that rally back out. Significant rally back out. We went from 410 in SPY to 413, 410 and a half to 413 and a half, a $3 move the next day. Now, I'm not saying we're going to rip to the moon today or that you should just go out and buy calls, right? It's not exactly what I'm saying here. And this call volume is for anything that has options. It's not necessarily just looking at SPY's calls and SPY's puts. All right, so, something to think about that these tools, they're not always so complicated after all, right? All right, that wedge that we're in is getting tighter and tighter and tighter. You can see on the daily out here. Using OCR, we're getting lower highs, lower highs, lower highs. So this compression is going to come to a head really soon. And I know a lot of people want to try to trade this in advance, right? Kind of have some idea that it's going to go up or that it's going to go down. But it really is a 50-50 coin toss at this point. We don't have a market maker move this morning, and the volume is within range of what we had through the week. We had, from a 90 to a 77. Now we're sitting at an 87. And we've had that lowered engagement since last Friday, 74, 90, 77, 87, just kind of holding underneath that 100 level. We're on the lower end of what's acceptable. We start getting below that 70 and we got to be a lot more concerned about what's on the docket in the morning, keeping everybody out, why they sit on the sidelines. If we already know what it is, then it's not a big deal, right? You got econ, something like that, then hey, cool, no problem. But we don't really have a lot of econ on deck today, not in the morning here, right? Housing starts and permits. I mean, don't get me wrong, it has been an issue before. You know, there's been times in history where we've gotten housing data and the market didn't like what it got. But for the most part, that's not one of the bigger ones that we anticipate really shaking the tree. So the lowered volume showing that lower participation, what are they waiting on? And the only thing I could think of is they're waiting on Fed speakers. We have a lot of different Fed speakers from around the world right now on the docket. All right, we had a pretty good sized gap as well. If you look at the 4 o'clock close and then the 6 o'clock open. Thinkorswim doesn't always show this very well. So if you don't trade futures much, or if you're kind of new to futures, at 4 o'clock, the regular person like you and me, we can't trade after 4. But the markets still move between 4 and 5 for a lot of different reasons, and institutions can still trade in that time period. So at 4, where we would consider the close, the market really isn't done moving. Most of the time, the gap isn't that big. It's not really anything to even focus on. But every once in a while, like with yesterday, we had that big sell-off. The market dropped down really hard and then was bouncing right back up again off of that level. The bounce continued all the way up until 5 o'clock. Then everything stopped. And then we opened up at 6 o'clock. That creates a gap between the RTH close and the Globex open. So we still have another gap as well between yesterday's close and today's open at 9:30. Now this gap got filled during that move in the kill zone between 2 and 4. But if it had not been filled, you definitely want to keep your eye on that one. It's already done. I'm going to go ahead and keep the line there, 41.22.5. If we go back down there today, that's going to be a level I want to focus on. And it's really close to the Globex low. So if you don't mark it, it's not really a big deal. Just mark your Globex low. It's good enough. I was really hoping this rebound would come in a little bit later in the morning so that we could all participate in it, but no such luck. Yeah, but wasn't the available jobs on LinkedIn, wasn't that part of a purge with LinkedIn cleaning its app up and making people verify accounts and all of that? Because I thought that drop in the available jobs was a part of a purge cleaning up their system. $10-day 30-minute volume profile. It's just like when Twitter does a bot purge, right? And all of a sudden engagement on Twitter drops by a third. We have the classic P shape. When we're at the bottom, we expect to go to the top. When we're at the top, we expect to go to the bottom. The point of control is not support or resistance. It's more of a gravity, an area where the most amount of volume was traded. So a price that everybody was happy with. Buyers were happy, sellers were happy, the most engagement in the market, 41.36. So, when I get that question all the time, what do we do with it? Is it support? Is it resistance? It's just where all the volume is. It's the greatest amount of volume is there. So you can have an expectation that price is going to react at that level, but it's not a support level to hold the market up, and it's not a resistance level to keep the market down. It's a place where we anticipate a lot of volume and volatility, and it's where we tend to hang out. So when we get there, it's like a gravity. It's going to try to hold us there. And what you can find oftentimes, depending on, if you're using Bookmap or Jigsaw or something like that, that once we get into that comfort zone, right, this little safety zone with price here, every time it tries to pull away from it, it just gets sucked right back down again, getting bid right back up off of the lows. And that it'll just sit here winding up more and more orders, flow coming in, and then till finally it explodes off of that level. All right, we got a VPOC from yesterday. It lines up perfectly with one of my old CPI lines. Call it 41.37 and a tick, maybe 3 ticks. That's it. 41.37 and a half. Now, when it comes to these points of control, some analysts won't consider that they've been hit at all until we're in the regular trading session. That's not my style. If we've hit it, crossed through it, and obviously we have, then I'm not really too interested in keeping it. I'm going to leave it there for this session, but I'm going to end up deleting it when I'm done streaming. To me, it's done. With these volume profiles, there's no wrong way to do it, right? And if you go in and say, take a couple webinars, read a book on these things, whatever, they'll tell you to carry forward the value area high, the value area low, the point of control. And, I've got mine probably set at 90 still. Whereas your default setting is going to be more like 70. So you'd be carrying forward those lines right there. I've already got enough pivots. I don't need those as well. But yeah, the idea wouldn't be that it's a VPOC. It would just be a POC, right? So you'd be carrying forward that line and then a line up there and a line down there. And whether or not it gets hit through the day, it would stay there until the end of today's trading session. I don't do it that way, but that doesn't mean that it's wrong. It just doesn't suit my style. The 41.11 cog line is the number one thing underneath this market right now that we want to focus on. There is a cog line at 41.31, but you know, we're so close to it and we're just crisscrossing back and forth through it. It's that 41.11 down at the lows here. If we break that, we're absolutely going down to this next little double bottom down here. That would get us right to the edge of the weekly expected move, right? That red line down at 40.70. So it's not a bad play. 41.11 down to 40.70. All right, nat gas still coming up off of those lows. This thing's got so much work to do. It's going to take a while. So this morning, nat gas is up to 706, 707. So it's up off of that low. It's a little bit of a concern, you know, that we had that nice gap up yesterday and then closed at the low of the day at the previous day's open. I would be really cautious this morning that, you know, we're up here at around $7. We're right around that 50% mark, right? If we were to measure yesterday's candle, 702, we're at 705. If this was pulling back for another leg lower, then we're right at that perfect spot, right? And it's kind of like this back here. We closed down there at the low. The next day we gapped up, you know, and it tried to make a run and it didn't make it. So with nat gas, keep your eye on that 737. And if we get a new low on the week, which would be below 678, then it's very likely we're going to come down and retest the 50% mark of this candle, 652. And that makes sense because on this measured move over here, it's 651 on the measured move for a breakout to the downside. Nice when everything lines up together, right? All right, banks are looking good this morning. And the semiconductors, energy. The things that aren't looking so good, Bitcoin, those K-Web constituencies, now clouds flat. Emerging markets, biotech, they're flat this morning too. So we got US dollar Japan running back up into that 137. It's a pretty significant level. Got a monthly line there at 37.17. And you can see how the market responded to it the last few times we've been up there. So the threat here is if we get up there and we take a hard, sharp rejection, start heading the other way. If you're short gold, you might get ripped up on this bounce off the lows. We'll have US dollar Japan rejecting across the highs. And as it begins to fall, we'll have we'll have gold bouncing on the lows, running back up again. So you can kind of see how my mouse matches on both of these charts. This sell-off in gold matches this rally in US dollar Japan. All right, so here we're looking at the TNX 10-year. We're coming up into that 36. The TNX doesn't open this early, so we use something like the micro 10-year. We got up into that 357, close to that 3.6 area. Took that hard rejection yesterday, and so far this morning, it's still falling out. Now it's stable, right? It's not like yesterday where it really started to move. But if we turn on the R line, I mean, that's pretty clear to me. So we're fading off. Want to keep our eye on trying to get back outside of last week's high, 3.51. We're underneath that level right now, but we got outside of it yesterday. Want to see if we can keep it. And if we can keep it, we're going to focus on getting outside of this really big indecision bar. So we had that big bearish engulfing, which I don't even like calling it that. It was almost all wicks, but I mean, still, that's what it is. And then we're inside week with these next 2 weeks. Being inside week behind such a really big candle doesn't hold a lot of weight for me, but we are still trapped inside that candle, so we got to get out of it. 3.594. It's kind of that line in the sand that we have to get through. We had that inside week breakout yesterday, and we closed yesterday keeping it, but we've given it back. So that's the number one thing I want to focus on today is it going to get this continuation or not? If it doesn't, then we're going to focus on breaking our own current week's low, and then we'll focus on 50% of last week, and they're pretty close together. 3.45 to 3.42. So, not too far apart, but that'll be our targets to the downside on this. So if you're wondering why it matters, right? And most of you aren't going to try to go in and trade that product, is kind of the effect of what we get with the S&P and the NASDAQ and everything else that's going on, right? So yields affect everything: bonds, yields, dollar, VIX, whatever it is that you're trading isn't trading in isolation. Trading the ES, SPY, Tesla. So you really want to kind of try to keep track of what's going on everywhere else. Get a feel for what could affect the market today. So while the S&P has been testing against the highs of this range, this 10-year has been in the lower part of this range. Big sell-off down, holding in the lower 50%. Right? If we were to divide this drop, we've been staying in the bottom half of it. And if we were to divide this, we've been staying in the upper part of it. So if these change, it'll be the opposite of each other. We get the 10-year getting up into the upper part here. We're going to have the S&P get down into the lower part here. It's really no more complicated than that, right? We're at a pretty critical spot here with the bonds. I'm looking at the 30-year. It's not as clean, and we've been seeing both stocks and bonds moving in the same direction quite a bit through all of this trash. So it's not so easy to just say, one's going to go up, the other's going to go down, sort of thing. But no matter which way we cut it, we don't want to see big moves in the bonds, right? I don't want to see these big, massive sell-offs and fast-paced moves. So keep your eye on the bonds today. The dollar, US dollar Japan, which was really starting to get out of line yesterday. I mentioned this a while back, how weird these bars are. I've never seen anything like it. I'm not using one of those bar charts, right? I'm using a candlestick chart. It does finally look like we're coming out of it, though, finally, and we're getting that move to the upside in the dollar. So if we kind of zoom out and looking at it in a bigger picture, this big bear flag also is part of a cup. And then, of course, yeah, it's a double bottom and a part of this bigger cup. Either way, it doesn't look bearish, right? So you really want to start thinking about, what's a higher dollar going to do? And when it comes to the dollar, it's not always a negative. Around October September, October, November last year, I started to warn, watch for the dollar to decouple. We were strongly inverse of the S&P, right? Every tick the dollar moved one way, the S&P was going the other. And it was a great tell for day trading. It was awesome. Then we decoupled from it. And still, if we had a dollar, headed to the upside, we had negative pressure on the S&P. It wasn't necessarily taking us to the downside, but it was really hard to see us rally on days when the dollar was rallying. That dynamic can change. Year and a half, 2 years ago, every time the dollar rallied, the S&P rallied with it. And when the dollar went down, the S&P went down with it. So it's not always going to be an inverse relationship. Right now, though, we just want to use those benchmarks to kind of line in the sand that we had talked about and have been talking about for a while. Getting above 3, you're very likely going to see the S&P below that 4,000 mark. Above 3.5, say getting into 104, you're looking at what, 3,900 in the S&P. So this thing really needs to calm down. We're still sitting right up underneath that $3 mark. We got to it and rejected off of it earlier, but keep your eye on that thing, because if it makes another run at it today and gets above it, we're very likely going to feel that in the S&P. All right, so this kind of fits into what I was talking about. Sure, the S&P didn't rally on a breakout. We're not inside day breakout to the upside like the dollar is. But you can see as I move my mouse across here that when we peaked in the dollar here and started to pull back, we already had rallied in the S&P for that last leg of the dollar, right? This push here matches with that run there in the S&P. So they're not correlated inverse markets that are always going to be a correlated inverse market. They're going to change, right? So the main takeaway today with the dollar, it needs to back off of that 103. Nice and easy, no sudden moves, and preferably get back down inside yesterday's levels. So we just close inside day. Thinkorswim doesn't have that 20-year bond auction showing here, but we do have that 1 o'clock auction today. So don't forget about that. Amazon and Google are still looking pretty good this morning. Apple's breaking out to the downside. Microsoft's basically flat. AMD's holding up well. And if we look at SMH, we gapped up really good off that close from yesterday, and we're holding the gap up, but we're still inside day. And NVIDIA, It's getting some flows. So we got semiconductors moving to the upside. We got an expectation of gold coming up off of that support level today. Really keep your eye on US dollar Japan though, because if it doesn't reject at that 107 and fall down, then gold's not going to rally up. Gold will break support and continue to fall to the downside if US dollar Japan breaks above that 107. You can play XLE for the strategic petroleum situation, or every Wednesday we got the EIA report 10:30. But USO I think is better, right? This is crude as opposed to a broad brush like XLE is energy, quote, energy. Well, that's vague. It's got solar, water, a bunch of stuff in it. This, on the other hand, oil. Oil report at 10:30, oil ETF. There could be some shenanigans. This one's worth keeping your eye on at 10:30 today. If you're going to get into trading oil, there's so much that you want to keep your eye on, right? There's way too much to get into here. For like those people that just trade oil all the time. That's a whole different breed. For us, 10:30, can think about every Wednesday, right? If you wanted to do this, go back and look at what previous Wednesdays did at 10:30. Did it, spike and run, drop off? That'll give you an idea of what kind of price action you could anticipate for today, right? You can see when the report came out, that big red bar to the downside, and then a really quick recovery back up. And then, right back down again. Nice megaphone pattern. Otherwise, all eyes are on debt ceiling news. I'm not a big fan of sitting and staring at finance juice all day long. But you're going to want to know, just like when yesterday, when the president said he was going to fly home early to get engaged in this debt ceiling, and that's when the market tanked. We know that we're all waiting on this news to come out. So as opposed to just a normal everyday kind of day where we're not really looking for a car crash, right now we're looking for a car crash. So some statement that says we're not going to make it, or some saving grace statement that says they came to an agreement and they're going to get something done. And there's more to it too. We can get downgraded just on the assumption that we're not going to get it done. Anything from Yellen too, right? I don't see that she's scheduled to speak. So if you start seeing anything from Janet Yellen in here, get ready for a move, because she's not on the docket to speak. I know, right? Getting downgraded to it, that's a big deal. So if, there's a number of things that can come out today, or not even just today, just this week. Finance juice is certainly something you're going to want to keep your eye on. And look, if it's something important, they'll highlight it, right? It's not like you got to sit and read every line. It'll be big, bright red. So what I do, I keep it in the background. And normally I make the window more transparent than that so I can see through it. And I just have it sitting on a screen on one of my other screens. And if a big red highlighted text comes through, then I just wake it up and see what the text is. That way I'm not sitting there worried about every tiny little level that comes through. All right, this Friday we got Powell speaking. It's at 11 o'clock. The speech itself shouldn't be anything. It's going to be, if they talk to him afterwards and ask questions. This isn't a policy announcement. It's a panel, right? So he's going to be answering questions, talking, debating, but it's not like he's going to come out with, this isn't a forum or a podium for him to make policy changes, anything like that. Still, when he talks, and generally when any of them talk, they have the capacity to screw up and say something inadvertently that they didn't mean to say, or the market can take something that they said out of context and do something really stupid. So you kind of want to just be aware of when they're speaking, even if you don't anticipate that they're going to make policy changes. Otherwise, everybody be careful, be safe. Keep your eye on tech versus finance. For a bull market or for a bull day and a bear day, a good bullish day or a good bearish day, these two are working in tandem, in concert together. You'll have finance and tech both doing the same thing. But we haven't had a lot of that lately, right? Like yesterday, for an example, NY Fang ripping to the upside all day, while finance, was range bound and really threatening downside moves most of the day. So it's this dichotomy right now of tech versus finance instead of tech and finance. So when these two both are on the same page at the same time, that's when we really start getting some moves in the market. They won't stay mad at each other, right? At some point, they're going to start working as a team again. That sell-off yesterday, for an example, was done on both sides. It wasn't as clean on the tech side, but it was that downside move, right? And look at the S&P during that downside move. You see what happens when they work together. We don't have much else to keep track of. There's 5 names holding up the entire marketplace. You kick the legs out of one of those names, and it's going to just weaken everything else, right? Like, look at Apple. I mentioned a moment ago, Apple had started to break down. Well, it's really breaking down now. Inside day breakout to the downside. We lose Apple, who goes to follow it, right? And how many names fit Apple's supply chain that it's going to take down at the open with it? So 170.98, if we move over here to the daily. Apple is already at that location this morning, which means it's really close to the bottom of this big red bar from May 5. We do have this gap to fill. It's a significant gap from 166 to 171. And some would argue, that that this gap needs filled too, where we closed there and opened here and ran back up, but we didn't close that gap, and then we jumped over everything. whatever is happening with Apple, it's not connected to financials. Like, like regional banks, I mean. I don't know. It seems to be directly connected to only Apple, not to other tech, but it can bleed over, right? So something to keep your eye on. Everybody have a good day. Be careful, be safe. I'll see you all tomorrow.